Welcome back to another episode of Mailbag Monday by the Money Matters podcast. I'm your host, Jack. I am sitting next to my father physically, so I'm out here visiting family. You've got Dollar Bill and Jack in the same camera lens, and then I'm joined by my best friend, Dylan. As a reminder, what is this podcast? I do a ton of media in Bitcoin. I've been in Bitcoin for 11 years now. This is a podcast that I enjoy that I get to do with my dad and my childhood best friend. It's a lot of fun. We shoot the shit and we try and just be as honest, as transparent, as authentic as possible. Because I don't know, I enjoy these conversations. These are the conversations that I would have with my family and friends when they weren't recorded. And I figured I'd record them. So I do so much media and a lot of the TV segments and a lot of the other shit. Sometimes they don't ask the right questions and sometimes we don't get to the point. And so I appreciate the fact that you guys are liking it. All of our numbers are up. I think we just hit 11,000 subscribers on YouTube. I think our numbers are like double over the last month. So we enjoy the fact that you guys are enjoying it. With that being said, let's get right into it with Dollar Bill. Dollar Bill, for all the newcomers, sorry, for those of you that have been with us, bear with me. But for the newcomers, because I think we have a lot of them, Dollar Bill is a segment from my dad, who's been in financial markets for over 40 years, and just his overall market assessment every single week. We might want to change this to the get long, get paid segment. But with that being said, Dollar Bill, what is your outlook on financial markets?
Oh, I got the easy part. My outlook on financial market is I'm trading them from the long side, and I can support our argument has been fiat debasement, asset inflation, and throw in the fact that it's an election year. We just think there's too much debt and too much illiquidity risk for financial authorities to do anything aggressive. You have year over year on this date last year, the Dow was at 34.4, so it's up 18%. Gold was under 1900 August 19th of last year. Now over 2500. That's up 33% on the gold market. Remember, gold does not produce a yield. You got to pay to store it. That, in my mind, is the number that jumps off the page most of telling the story we want to say of dollar debasement. I use the Case-Shiller index to track real estate, but I don't trust it. It's only up 5%. But anyways, three different asset classes, three very different supply-demand fundamentals, and all showing strong year-over-year percentage gains. The only thing all three have in common is they're priced in dollars. That's been our overall macro approach. And with an election year and this much, I know I watch too much TV, but too much news. But the Republican candidate almost got shot, and the Democrats is kind of a circus. There's just a lot of uncertainty, and I can't imagine monetary authorities wanting to insert themselves into this environment. And the easiest example, let's say they were the Fed or Treasury to do something accommodative that's not priced in. You can easily send the stock market to an all-time high. That can't help. That's going to help incumbents. You just swung some undecideds into the incumbent part. People tend to vote their checkbook. Likewise, an unexpected restraining move by monetary authorities sends markets down sharply. You know what? Throw these bums out. I've had enough. My 401k just got hit. That can't help but hurt the incumbents. So I think monetary authorities are sitting on their hands for the time being. We're on our own, and as you know, markets, when they're on their own, they want to go higher. And I'm looking at strong percentage gains across the board. I'm trading from the long side. I think this markets still have room to run.
Well, so you don't think that they're going to push the S&P higher?
Well, I don't know about
I don't think
they're going to do anything. And so markets left to their own are going to go higher. Yes, I am. I think very good chance that
we need dollar liquidity somewhere.
But I don't think they're going to do anything unexpectedly. I just don't think monetary authorities lose credibility when they insert themselves right into a very volatile, political season. I wouldn't. And believe me, I like criticizing monetary authorities as much as every other Bitcoiner, but I wouldn't do anything either, right? Would you? Then because you pretty much
if I lose the election, I'm not in office anymore. Janet Yellen, if the Democrats don't win, our sweet grandma garden gnome is getting her ass kicked the fuck out. So right. So I gotta make sure that everyone's savings account is booming leading into November.
That's too overt an intervention for monetary authorities. I think they lose too much credibility. That's just cynicism. Well, now every election year, we got to figure out which party appointed you and which party is likely to retain you and trade accordingly. That's going to happen every 2 to 4 years. I think they are going to stay as far away from surprising markets as possible through this election season, right? Because if they don't, then
I don't think they have any. I disagree. I don't think they have any credibility, but I think that people are still living in the times of 2008 to 2020, where everyone's leaning on every single word that the Fed chairman says. I don't think that, I've said this a million times, I don't think Jerome Powell is the most important financial person in the United States of America. I think it's Janet Yellen, which is more fiscal dominance, which is more, we're living in a world of way too much debt, as opposed to we live in a world where we care about the interest rate. I don't think the interest rates matter. Rates have been up and stagnant for the last 2 to 3 years. And you just read the year-over-year returns of everything priced in dollars. So it's inflationary somewhere, but it's not inflationary from low rates. It's inflationary from dollar liquidity from the Treasury. So I think Garden Gnome Yellen is going to find dollar liquidity leading up to November and push assets higher, push the S&P higher. I am very confident that the S&P and Bitcoin are substantially higher. Well, Bitcoin, because it's the best reaction to dollar liquidity, but I think the S&P is higher in November than it is right now, substantially.
So you've said a few times that you believe that Janet Yellen is Jerome Powell's boss. For anyone that doesn't know, what do each respective member own, and what does it mean for Janet Yellen to be Jerome Powell's boss? What does that mean?
You want to take what they own, and I'll take why I think she's more important than Jerome.
Oh, I think if you're like, how monetary policy gets how the policy gets set and executed is a confusing technical what Treasury does and what the Fed does is really mind-numbingly difficult. I just said, what printing money, easing, you tend to say things like, money printer go burn stuff. Well, how does that actually, other than time they mailed out stimulus checks, that was pretty direct. Then you could really put your finger on the fiscal stimulus, but it's usually more opaque through, the banking system. But either way it works. It tends to work its way right through, mortgages, credit card interest rates.
Because from what I understand, I believe that Janet Yellen's job, if you were to one-line it, is to execute on the president's strategy, to make sure that there's dollars in the system to execute. The president says, I want this, that, or the third. The Treasury is responsible for essentially executing on behalf of the president and his sort of fiscal requests. And then Jerome Powell, from what I understand, again, a brand marketing guy, but from what I understand, Jerome Powell's one-line job is to protect the U.S. dollar, to make the U.S. dollar as strong as possible.
I don't agree with that. I think Janet Yellen's job is to finance the government. Make sure the government can spend the money that they want to spend to do what they want to do. So I guess that's another way of saying supporting the president. But if the president wants to go to war, if the president wants stimulus checks, if the president wants to, supposedly there's a presidential candidate that wants to cap the price of certain foods, if the president wants to do things, then the Treasury has to finance that.
Yep.
Jerome Powell has certain mandates like jobless claims, like inflation. And so his job is to really support a bustering, amazing economy. So something like, how do you measure how well Jerome Powell's doing? Well, what's the economic growth in America? What's the inflation rate? How many people are employed? Supposedly,
Well, that's the only two, right? It's
Yeah.
a dual mandate, right? It would support the economy and protect the purchasing power of the dollar. We just don't think they're going to do that much of the latter.
well, that's my point about fiscal
Yeah.
dominance. So his dual mandate is the what my dad just said. The problem is when you're in this much debt, the one mandate for everyone in financial authority is don't let the debt consume and destroy the United States. If Jerome Powell actually cared about protecting the purchasing power of the dollar, he would keep raising rates. He would be on a warpath to hit his target. Why are they talking about changing the target? Why did he pause? Why are assets up year over year, although rates have not moved in 18 months? He's clearly trying, in my opinion, Jerome Powell's more focused on keeping an orderly market in treasuries, not trying to hit his dual mandate. And so that is fiscal dominance, is when the fiscal government spending is dominating the independent dual mandate of the central bank. Reminder, the central bank is a private independent bank. It is supposed to act outside the interest of the government to protect the American people. Unfortunately, that's far from true. And I think we're living in a very unique time. People keep bringing up like the 1970s are starting to look like the 2020s. We might have a decade of inflation, but there's a huge difference between that time and this time. We have $35 trillion worth of debt. Our debt to GDP is over 120%. So the arsenal that you have to fix problems is not nearly the same. You are teetering on the edge of utter and complete disaster. And so all the liquidity that we've seen in the 2020s since Jerome's had the fastest rate hike ever to curb inflation, it's all come from the Treasury. It's all come from Janet Yellen. And so in my opinion, the most important financial authority in the world and in America is Janet Yellen. And Janet Yellen tells Jerome what to do. In real fiscal dominance, Janet Yellen is technically Jerome Powell's boss. That's when you merge the Fed and the Treasury and the bank becomes part of the government. We're not actually there yet, but I make the argument that we're practically there. And so do many other people, is that all that matters is the government's fiscal situation. And actions from the Fed have more to do with the government's fiscal situation than it has to do with their dual mandate. And then if you think of it that way, okay, the government's in a lot of debt. They have two options in theory, pay it back or default. In reality, they can't have either. Debt to GDP over 120% means they're not producing enough growth to pay back the debt. The United States of America defaulting on debt is not an option. So the only way out is through. The only way out is printing money. That's the get long, get paid. That's the currency debasement. And so they both play a part in that. I don't think interest rates matter anymore, or right now. I think Bitcoin can go to $1 million with interest rates at 5%. Clearly. Because listen, there's the price of money, which is rates. There's the quantity of money, which is the amount of dollars printed. And Yellen, clearly, rates haven't moved in 18 months. Bitcoin's gone up over 100% in 18 months. How? There's more dollars in the system. There's more credit in the system, although rates remain high. So rates will probably have to come down so that the U.S. doesn't fucking go under, because they can't afford. Listen, rates, when everyone's like, man, I can't afford a house right now. My mortgage would be too expensive. Imagine trying to finance $35 trillion worth of debt at these rates. You think your mortgage is expensive? Imagine the U.S. government's fucking mortgage. They can't afford this shit. So rates have to come down at some point so that they can afford it. If you look at the receipts that the government uses to pay and to finance all these interest payments, like we're almost at like 100% of the receipts that they collect to pay. That's not good. So rates, either they have to cut down spending immediately or rates have to come down soon. But I think that liquidity comes from the Treasury. I think it's Janet Yellen's show, and that's fiscal dominance. Hopefully answered all your questions.
Yeah, no, absolutely did. And so with $35 trillion in debt, you say that rates eventually need to come down in order for the US to pay that off, to attempt to pay that off?
Yeah, so listen, if you look at how does the US government afford its interest payments. So they have interest payments on whatever, trillions of dollars of debt. They have to pay that. How are they paying that? One of the biggest ways the government pays for their interest is capital gains tax receipts. So let me say that again. The government benefits from assets going up in America because people get really rich and they collect tremendous amount of taxes. Like when people are like, the US should just wipe cap gains from Bitcoin. Yeah, I doubt that's coming anytime soon because Bitcoin's the best performing asset in America, in the world over the last 15 years. And the way they finance a lot of this stuff is the fact that a lot of the boomers in America I think boomers own $70 trillion worth of assets. Those assets go up. There's lots of tax receipts. They're able to finance that. Okay. If rates remain high, government spending keeps going. Biden has not slowed down spending. Both Trump and Kamala, both Trump and Kamala are campaigning on spending more money. Both of them. No one is campaigning on reducing government spending. So if rates are going to remain this high and they're going to continue to pile on the debt, at some point, you're not collecting enough receipts to cover your payments. So what can you do? You can either reduce government spending or you can lower the rate of interest. You have to make room to be able to afford this stuff. The other thing you can do, which they'll do, in my opinion, is create an asset bubble. Why is an asset bubble a good thing? I think Bitcoin to 500K, the S&P 500 up 100% over the next 2 years, gold to 4,000. Why would these things be good for Janet Yellen, Jerome Powell, whoever's in Treasury, whoever's the chairman of the Fed? Again, because when assets go up, they get more tax receipts. They're just buying themselves more time. You send Bitcoin to 1 million, I'm going to try and buy the Chicago Bulls. If I try and buy the Chicago Bulls with Bitcoin, I mean, I'm going to pay the government a lot of money, right? And they're also weakening the dollar. They're also debasing what they owe. So again, anyways, all of it is they have to debase the currency to get out. They have to create a bubble in assets. So you should own assets because it's in their best interest to send them higher. You should not own dollars because it's in their best interest to send it lower. I think the focus is on the Treasury because the fiscal position is utter and complete chaos. I think Jerome Powell is on his knees compared to bad bitch Yellen. Bad bitch Yellen calls the shots.
That's hilarious. So you said that the government needs to do two things: send assets to a bubble, lower rates, so weaken the dollar effectively.
Hold on. They can send assets higher without lowering rates. Like I said, rates haven't moved in 18 months. Bitcoin's up over 100%, means Bitcoin's doubled. They can send assets higher without lowering rates. So people should stop hinging on everything Powell says. Is he going to cut? Is he going to cut? It matters what Janet is doing. But for the US government to be able to afford its interest payments, yes, either they should stop spending immediately or rates will have to lower, but that's to continue to finance the debt, not to send assets higher. They both kind of interplay, but I think it's a really important distinction. Like Janet will at some point go to Jerome and say, I need to afford these interest payments. Interest payments are exceeding my tax receipts. Send these fucking rates lower now. And again, this is fiscal dominance where Jerome on his knees, yes, Gardenome Yellen. Yes, I'm so sorry. Yes, Gardenome Yellen. What about inflation? Shut the fuck up. I don't care. We'll figure out inflation later. That's a political thing. We'll change the target, et cetera, et cetera. So I think they changed the target to 3%, comes out at 3.8%. Oh, look, we're kind of close, but rates get lower so that Yellen can continue to finance the government. but it has nothing to do with assets. Assets can perform no matter, rates have been stagnant and they've still performed.
Right. But it sounds likely that the government, at least directionally, has to consider both of these options, doing both of these things, sending assets.
And ask yourself, so like, what's one of the biggest government spend? What's one of the biggest government spending divisions? Defense. Right, defense. It's defense budget. What if Trump or Kamala came out and said, I'm campaigning on decreasing our defense budget by half, while there's like World War III fears? No chance. Zero chance. So the question is, where do you cut spending? I don't see any politician cutting spending anywhere. So you can do a few things. You can cut spending. So you can say, listen, if World War III breaks out, I'm the president that's campaigning on making sure we're not as prepared as we probably should be. Okay, you're not getting elected. You can reduce rates to make it more affordable to finance these interest payments, or you can create an asset bubble by debasing the currency and providing more dollar liquidity. Really, that's what Yellen's job is finding ways to inject dollar liquidity. Those dollars find themselves in hard assets. The hard assets go up. The purchasing power of the dollar goes down. And in that way, in these asset bubbles, you get larger tax receipts. So your income you're generating as a government goes up when assets go up, and what you owe goes down because you're debasing the US dollar currency.
You know what I always want to ask you guys, if you had this opinion and we didn't have Bitcoin, how would you guys be trying to protect your paycheck? Would you guys be like DCing into an ounce of gold? Would you guys be going for gold ETFs, or would you be looking at a real estate ETF, or just regular old S&P 500s?
I thank Satoshi every day.
I mean, a deflationary asset, like we say. Google how much gold there is in the world, and I think Google returns an answer plus or minus 22 million tons. It's
well, here, let me
you guys are storing value in something where we literally don't know how much of it there is.
Let's transition this into the long end that we were talking about. So I have the opinion that the long end is a problem. The long end is long duration treasuries. So 10-year, 30-year. Well, the conversation we were having last week is, I think there's a problem. There's no bidders for the long end. I think that Jerome, I think the financial authority's job is to make sure that no one dumps their treasuries and you keep an orderly market in treasuries. That's why you saw a swap line between Japan and the US, in my opinion. And I just wanted to back some of that up. So as of the latest data, T-bills, so short-term T-bills, now make up 40% of total treasury debt issuance. That's up from 15%. And I think that the Fed will have to buy the long end eventually, which is printing money, because clearly nobody is, in my opinion. And for the listeners, and I want to hear my dad's opinion, no one wanting to buy the long end is fear of inflation / currency debasement. You wouldn't want to hold a return in dollar terms for 10 years if you thought the purchasing power of the dollar was going to get rapidly debased, right? You would not want that much counterparty risk with the US government. You would not want to have to trust them for that long. Instead, you loan to the government, but on short T-bills. Short T-bills, like 3-month bills. That way you're not at risk. You can take inflation risk for 3 months. You want to take inflation risk for 10 years? What's the price of Bitcoin going to be in 10 years? And so the fact that there are no buyers for the long end is a huge problem. And the way treasuries work is when people sell treasuries, the yield goes up. That's just bond math. So if everyone's a seller and no one's a buyer, then the yields go way up. The government can't afford that. Like I said, if the 10-year goes higher in yield terms, then everyone's going to question the solvency of the US government. So when I say Jerome Powell is trying his best to keep an orderly market in U.S. Treasuries, is preventing people from selling it and trying to find buyers. While no one wants to buy the 10-year, so Yellen keeps issuing short-term T-bills, so shorter at the short end, not the long end. So Yellen's issuing more at the short end because there are no buyers at the long end. And everyone that owns Treasuries, we keep opening swap lines to give them freshly printed dollars so that they don't sell the Treasuries. Because they sell the Treasuries, the yields go up. The yields go up, the United States solvency is in question. Does that make sense, Dylan? So my fear is that the fact that, first of all, the fact that no one wants the long end of the curve means that we're right, means that everyone in the world, including the biggest markets in the world, are fearing inflation and currency debasement just like we are. If no one's willing to buy that, is the United States willing to let the free market set rates? No, they can't. They've got too much debt. They can't let the yields go much higher. So if not, then the Fed has to buy the 10-year from the government. That is printing money. You are printing money to buy the debt. But Jerome is printing dollars to buy Yellen's debt. That's the massive money printing. So right now they're trying to find buyers of the 10-year. They're trying to prevent sellers from selling. And I think eventually the Fed has to step in, buy the 10-year, massive money printing, asset bubble. So anyway, that's what when I say the long end is in trouble, it's in trouble, in my opinion.
The problem,
But Bill, you disagreed with this last week.
yeah, well, no, the problem with the no buyers at the long end argument is that it's at 4%. It used to be twice that. I mean, that is not a distress. I just don't see a 4% 10-year yield, 4.1. And look at the yield curve. I mean, it's just the same as it's dead flat.
Yeah, but how many of those do you own?
I don't.
Zero.
Probably none. Yeah.
Why
I don't
not?
know.
Why don't you sell your Bitcoin to own that? Let's go through that mental exercise. Why don't you sell your Bitcoin to own 4.1% interest or payments a year, or not interest yield?
I mean,
because Bitcoin's doing 63%.
Yeah, and gold and real estate and everything else you can find.
Okay, so you just walked us
Right.
through. So what is this? The Dow?
Yeah.
So the Dow's up 18%, gold up 33%, and this is the housing index,
yeah.
Case-Shiller housing index up 6%. That was your dollar bill segment. All of those numbers are higher than 4%.
Right.
So why would you own that?
Why would you? Well, I mean, treasuries are foundational to everything. Sometimes if you got to support, if you're margining anything or using any type of leverage, it's always in treasuries. I don't. Yeah, it's well. Why would you? Yeah, but I don't see distress in a flat yield curve and 4% 10-year. It just does not look distressed to me.
Well,
Distress would.
I don't know
It
if
would
I'm
be more of a sloping. If we're losing faith in 10 years, then why the yield curve doesn't slope positively? It's just dead flat.
I think it probably was going to slope positively if we didn't open a swap line with Japan. I mean, what happened at one point is all of these other countries were in trouble and they just started dumping their treasuries, and it did. It was like, if you pull up the 10-year chart, it was, and then we brought it right back down because we just gave them a swap line. We said, here. If you need to finance problems, just take freshly printed dollars, sell the dollars, don't sell the treasuries. But what I think we're seeing is a transition away from treasuries being the world reserve asset to something else, gold. I mean, what you're saying with China and what you're seeing with all these other countries buying up all this gold, they're selling treasuries, buying gold. I think that the treasury is on its way out. And again, so what Yellen does is she has new debt issuance to finance the government. So she issues new debt, sells new debt. The short end used to be 15%. It's now 40% and rising, meaning she has no buyers at the long end. There's less and less people willing to buy the long end, because if you're getting a fixed yield in dollar terms, you're reliant that the dollar is going to retain its purchasing power over 10 years. And there's less and less people willing to bet that. And so again, it's just the market wants it higher than 4%. I bet if the 10-year was at 20%, I'm sure Yellen can issue a lot. I bet the short end goes down from 40% back to 15% or lower. But it's not. The market is saying, I need that 4.1 to be higher. And the government won't let it go higher because they can't, because of the debt situation. That's my opinion.
Who the largest buyer of the 10-year is right now? Do we know who it is? Because you asked Bill, why, do you own any treasuries? And then given the performance of every other fixed asset we've talked about, why would you? I think the more important question, or at least the more interesting one to me, is not why would like an individual, but why would anyone?
Yeah, well, I think we're figuring out. I think like the 60-40 portfolio is dead. I think everyone's realizing the suckers at the table are those that hold bonds. I think that is what's happening. I mean, really, too. I pulled up this. Let me pull this up. So for those that are not watching on YouTube, I will just voice over. But for those on YouTube, I'm going to share my screen. I made this chart this morning because what I think is happening is really what we want to measure is your purchasing power in energy terms. And so I like oil. And so this is the SPXTR. So the S&P total returns. That's what this is. So the S&P total returns, what I'm showing for those listening, since 2020, the SPX total returns is 83.59%. So since 2020, you're up 83.59% in the SPX total returns. Now, if you measure SPXTR against gold, so that's XPXTR over USD. So in dollar terms, it's up 83.59%. Is it up in gold? What's SPXTR over gold? 14.52%. Okay, so you're still up. So for all the gold bugs, you're better off owning the S&P than gold since 2020. Now, are you up in oil terms, which I think is energy terms? Energy is the foundation of society. It's how we do shit. No, the S&P total returns against oil is down 71.97%. What is the only thing that's S&P is down worse than oil? Bitcoin, but not by much. Bitcoin 74%. So what I think we're seeing is like the dollar and the treasury market in oil terms isn't keeping up. And so people are rotating out of treasuries, out of bonds into, we talk about harder assets, fixed supply assets, but at the end of the day, it's assets that can protect your purchasing power in energy terms. And so this, to me, this is insane because there are people like our friends are like, yeah, my stock portfolio is booming. I'm up 80% since 2020. Yeah, you're up 80% in dollar terms. How much in gold terms are you up? Oh, I'm up 14%. Well, how much in Bitcoin terms are you up? You're not up. You're down 75%. So you've lost 75% of the ability to buy Bitcoin by sitting in the S&P 500. And so I think there's just a rotation. Anyway, this chart to me is insane. Also, it shows you which asset is the best at protecting energy purchasing power, which asset is the best at being energy money. How good is gold at proof of work versus Bitcoin at proof of work? Which asset seems to be tracking oil, barrels of oil best? Bitcoin, by far. But anyway, why would you not own the 10-year? Or why would you own the 10-year? I think it's just about purchasing power. And the dollar is not like dollar to oil, no good. Bad. Bad.
Yeah, I mean that chart is fucking nuts.
I know. It's a great chart.
Yeah. That's a chart to leave a group of people speechless for a few seconds. You gotta wrap your head around that one. That fucking shocked me.
Yeah, I made that one this morning. For all the listeners, listen. Money fundamentally is, I've said, time and energy in abstracted form, right? because all you have on this planet is your time. The way you spend that time is contributing energy, and what you get in return for that is money. Whether you mow lawns, you fix windshields, you do podcasts, you run a company, you get money in exchange for your time and your energy. How do you price energy? What's the cost of energy? How do you measure energy? I think right now it's like barrels of oil, right? So the reason I pull up oil is like, when you invest in the S&P 500 over the last 4 years since COVID, how many more barrels of oil have you gotten? How much more energy? Because think about our life in energy terms. I'm recording this on my laptop. In my pocket is my iPhone. Later today, I get on an airplane. Our life, human civilization, is our ability to commercialize energy from the sun and progress our species. Generally, that's like what it is. That's also like eating a steak and consuming calories and then expending those calories to like be alive. If you stop eating, you die. No energy. So if you look, you should measure your purchasing power in barrels of oil or in Bitcoin. You saw in that chart, they're kind of effectively the same thing. Bitcoin is energy money. When people say, oh, proof of work is a waste, all this energy is a waste. No, those people don't know what the fuck they're talking about. What Bitcoin is saying is, oh, you want to create new money into the universe? Show me the energy. Show me the energy expenditure to create new money. Bitcoin is energy-backed money. So I think that treasuries, the bond market, dollars are rapidly losing purchasing power in energy terms. And so everyone's trying to find a way to protect their purchasing power in energy. Money is time and energy in an abstracted form. How to measure that? Probably barrels of oil is the best way. Probably. And so S&P 500 over the last 4 years, you get far less oil, far less energy, far less vacations and technology and air conditioning and television, all the things you use all day. You get less of that. So you get less Bitcoin, less oil. You're up in gold. So how good is gold at protecting your energy? Yeah, not great. But in dollar terms, 84%, right? It's the same as Argentina, by the way. Let me end with that. Like the Argentina stock market booming in the Argentine peso because it's not worth anything. It's the same thing. Stock market booming in US dollars. Is the stock market booming measured in oil or Bitcoin? No, it's crashing. So I don't know. So if you own Bitcoin, you're gonna have more energy in your life. You're gonna have more stuff. That's my case in point. I'm done ranting.
Well, I woke up this morning and checked my Robinhood account. I have a measly amount, or like notional dollars worth of stocks in there, but I do like to see it go up. And now you took that happiness away from me that I felt this morning.
Well, let's think about what Saylor's doing. What is Saylor doing? Saylor is arbitraging the fact that the S&P 500 is worth too much, or just the equity market generally, just stocks, and Bitcoin is worth too little. Because what he's realized is exactly what I'm saying. The SPXTR doesn't protect your purchasing power and energy. Your life is still being drained by sitting in the S&P 500. It's not keeping up with barrels of oil, which again is just a proxy to living your life, your air conditioning, your TV, your cell phone, your ability to fly, travel, call an Uber, everything. And so what he's doing is he's effectively siphoning money out of the public markets and into Bitcoin. It's just a giant arbitrage trade. The S&P 500 is over monetized. It's worth too much. It's overvalued. And he's taking, well, not just the S&P, overall equities. The SPXTR is my measurement, but I could have used something different. And he's sucking money out of that into Bitcoin. So in theory, the public equities will come down, Bitcoin will go up. And until those have reached an equilibrium, which we might be like 50 to 100 years away from that. But that's why he's making so much money, is he's just arbitraging that difference, is that everyone's sitting in the public equities market looking at their return in dollar terms and not in oil, not in Bitcoin. And Saylor's looking at everything in Bitcoin and sats. He talks about sats per share at MicroStrategy. So he is just a different denominator. It's like everyone's measuring their net worth in Argentine pesos and sailors measuring it in the dollar. That's the analogy. And he's like, oh shit. Yeah, sure. I'll issue more equity. I'll take on dilution. I'll get more loans. And everyone's focused on the Argentine peso and I'm buying the harder currency. That's literally all that's happening at the end of the day, what he's doing.
And let me ask you both a question. And I'm going to ask this question and I'm going to try to phrase this to the best of my ability, but I'm going to caveat it with the answer, because I know both of you very well at this point. The answer, Jack, specifically, can't be that there are, more buyers than sellers or more sellers than buyers. And that's why you see the price, the Bitcoin price performing the way that it is. Okay. So your thesis is that we are entering or at the sort of emerging state of fiscal dominance, that there's too much debt in the system. We simply need to print more dollars. And in conjunction with that, we personally hold too much debt. The interest payments are too high. We need to weaken the dollar to be able to essentially cover our own ass, cover our own mortgage payment. I really like that example. The United States has a very big house that it needs to pay a monthly bill on. With all of those factors being considered, why are we seeing for the past, 4 months, call it, Bitcoin just kind of chopping sideways? Like, at what point does it price this in? Because get long, get paid implies that a price chart can't chop sideways forever. In order to get long and get paid, you need to see price action, curve up at some point. What do you think will be the tipping point for that? And why do you think we've seen so much sideways action given this sort of macroeconomic backdrop?
My personal opinion is Bitcoin is the best. It's the best at sniffing out dollar liquidity. So all of these things we're talking about is future. We're assuming these things. We think that the direction, and by the way, to our credit, we've been right? But what about actuality? Where is the dollar liquidity? Like, if you look at when Bitcoin kind of started to chop around, the reverse repo, which banks have been using to tap liquidity, kind of bottomed out as well. It kind of stopped. And so I think that there's been a lack of dollar liquidity over the last 4 months. I think anyone rich or important goes on vacation, markets kind of chop, Bitcoin's kind of chopped, no dollar liquidity. I've said this before. I think my expectation is everyone rich and important gets back from vacation soon, have elections to win, have bad decisions to make, have lots of purchasing power to deploy, like the Ken Griffins, the Don Wilsons, like real capital, have to make decisions soon. And so I think markets will start to move again soon, like Q4 especially, maybe September. But I think what Bitcoin's best at is sniffing out liquidity, right? So what happened? The Japanese central bank raised interest rates by 25 basis points. Bitcoin took a nosedive on a Sunday. What was it saying? Liquidity bad. Dollar liquidity bad. Not good. And then came out, made a statement, said, we will not do that. We're here to do what? Give you guys dollar liquidity. Keep assets fine. Bitcoin went right back up. So I think Bitcoin is the only smoke alarm left. It's the only escape valve alive. It's the only free market we have. So it's always telling you the truth about dollar liquidity. And so my expectation is Yellen, before the election, is going to find new dollar liquidity. I think she's going to do something to give us dollar liquidity, which sends assets higher. And you will know exactly when she does it by the Bitcoin price. So I think there's just been a lack of liquidity. And I think that's her job right now, is to go find more. My opinion.
Anything to add there, Bill?
No, just real quick. This is the 10-year. This is a chart of
Oh, nice.
of the 10-year all in. So that's yield plus price appreciation. And if that looks to you like we can't finance our debt, I mean, that's a bull market. I just don't. That's the only. I agree with everything. We're both arguing from the same stance that you do need hard assets to protect. But I don't, that just does not look like distress. I do not think the government is having any trouble finding buyers for their massive amount of paper.
Then why are they issuing 40% T-bills?
I don't know why. The yield curve mix, I've never really understood why they jigger with it. But I mean, they're having no problem getting rid of it. I don't know. That just does not look like a distressed market. Your argument is that it's just not protecting you as well as stock, as well as anything else you can name.
I think,
but it's not going down. Anything else you can trip over yourself and do better than 7%, right? Like I said, 18% for the Dow, the gold up $500, $600. That's 30%. Real estate, obviously Bitcoin. So while I agree that you have underperformed with Treasury yields, but you're still up 7%. I mean, it is a lot of liquidity. I mean,
I just think there's a lack of buyers and increased sellers. China stopped buying. Japan stopped buying. China wants to sell. Japan tried to sell, and we didn't let them sell. So
yeah, I think something interesting. Well, some inside ball. At one point, we wanted to name this podcast, or at least I did, Dumb Guy, Smart Guy. And for the viewers out there, the smart guys are sitting with a mahogany backdrop, and the dumb guys sitting in a dim lit room dressed in all black. And so I thought a point that you brought up earlier, Jack, was super interesting, that Japan did try to sell, and we propped that up. I quickly looked up who the largest holder of T-bills is currently in 2024. It's Japan. And you mentioned this point about a swap line, and I was trying to think, like, do we have a swap line open with anyone else? And so, that combination of factors makes a ton of sense. I'd be so curious what that chart looked like if we never had opened that swap line and Japan was just allowed to,
the yields
net sell.
The yields would be through the roof. Because again, for the listeners, when treasuries are net sold, the yields go up. That's just the bond math. And so we can't afford that. And so when they were like, shit, we're in trouble, the way Japan works is they have negative rates, zero rates, but they own a lot of stuff. So their balance sheet is kind of offset by owning a lot of stuff. They're the biggest holder, to Dylan's point, in treasuries. And so whenever they have economic situation, again, what do I always say? You sell what you can, not what you want. Maybe Japan doesn't necessarily want to. I think they probably also want to, but maybe they don't want to, but they have to, kind of. It's their position. And so they started, there was at one point it was like, okay, here, boom, $100 billion worth of treasuries on a Monday. Boom, another $100 billion on a Tuesday. Boom, $100 billion on a Wednesday. Boom, $100 billion on a Thursday. And then we were like, enough. Swap line. And what's the swap line? The swap line is here. You can take freshly printed dollars, print as many dollars as you need, so you can sell those dollars instead of your treasuries and finance what you want. We'll take whatever, Japanese yen, which is worthless on the Fed's balance sheet. So it's not a swap. It's just printing currency. The Fed's going to have to socialize that loss on their own balance sheet, but it's just to protect the treasury market. So again, there are more sellers out there. Also, China. Like, everyone's always like, China is buying gold and all this stuff because they're going to try and create their own world reserve currency. They're trying to take over the US. I don't think that's true. China has seen a lot of growth over the last 30 years, and they need energy. Okay, right? We all do. So, okay, what does that mean? They need oil. Okay. So if they're going to be traded, like what you're seeing is the Middle East and China starting to settle these trades in oil. We kicked Russia out of this financial system we're talking about. So what does Russia do? Starts buying a lot of gold. So China and Russia buying gold, trading oil for gold. It's because it's protecting their energy purchasing power. And they don't want to be buying their energy with dollars and storing their energy purchasing power in treasuries. So they're selling the treasuries, they're buying gold. What does that tell you? So you're having more net sellers of treasuries. Who's buying the treasuries? And the question is what the U.S. government's trying to figure out is who can buy it. Maybe they're going to make an accounting change or let banks. So like one of the buyers is banks. So this is the scam of the financial system. You deposit your paycheck into Chase. Chase takes that and buys these long end treasuries that nobody else wants. And then when it's really bonds, but when the bonds fall and then your bank deposits aren't there, that's why SVB went under. So who's the sucker at the table? Janet is trying to find the sucker at the table. Who can buy the long end? And they haven't been able to. And if they can't find it, then she will go to Jerome and say, Jerome, get on your knees and buy this long end. And he will. And that'll be extreme money printing. So that's the situation. But if anyone threatens to ever sell, we're going to give them a swap line. We cannot afford the yields to go up.
Fair enough.
And so Tether, by the way, Bitcoiners are listening. So Tether, one of the reasons the government loves Tether, theoretically, is because they're a huge buyer of debt. Janet can issue new debt and Tether's buying it up in droves. But what are they buying? They're buying short-term T-bills. They're not buying the long end, right? Paulo is not buying the 10-year. He's buying 3-month T-bills. So what does Janet do? Again, why? Because nobody wants 10-year counterparty risk with the U.S. Treasury. They don't think that in oil terms, in Bitcoin terms, in energy terms, they're going to be protected. They'll take 3 months. If you're going to give me risk-free return for 3 months, sure. 10 years? No, thanks. And so what does Janet do? She starts issuing more of the short end, more T-bills. So I think that the long end just it's not as deep a market. Maybe we can agree on that.
We'll see if it falls out. 5%, 6%. Yeah, then maybe.
I don't think they'll let it get that high.
They
can't.
If they like to monetize all assets, that's fine with me too.
Yeah, I think that they won't let it get that high. Again, with the printing money, asset prices go way up. So like an asset bubble what about the asset bubble from 2020 to 2022, Dylan? So that's the COVID asset bubble. So the dollar got debased and their tax receipts went way up. They're able to further finance. So I think you see another massive asset bubble. I think we see the biggest asset bubble in human history. I think Bitcoin goes to 250,000 to 1 million, like I said. That will buy them more time. The dollar will be debased. Their tax receipts will go up. They'll give them more time. And then the asset bubble will correct. And who knows what happens after that.
Well, we're free market guys. Let us know in the comments. Who do you think is right? Is Jack right? Is Dollar Bill right? And then at the end of the day, Papa Time, Grandfather Time will give us the answer.
Yeah. Also, can you tell that this is my dad standing next to him? Do we look alike?
Yeah.
Yeah.
I've known you guys for like 20 years at this point, but yeah, I think it's suffice to say that you guys look alike. It's in the eyes, Chico. They never lie.
You're looking at the most powerful banking family.
Bankers.
Oh, wait. This will be funny. Hold on. We printed it out and we hang it in the kitchen because we just think it's so hilarious. Neither of us have ever worked in banking, but there's always rumors about how powerful our family is because we got early into Bitcoin. There are very few. Can you read that?
Yeah, back it up.
There are
very few bankers as powerful as the Mallers family.
There are very few bankers as powerful as these two right here.
You're fired.
All right. Well,
What do
you
bankers
guys
say? I don't know.
I don't know either.
Fuck, it's 9:00 lunch. We're closed. It's a 3-day weekend. Monday, isn't it? I'm a banker.
But yeah, we got to run. Thank you guys for listening. keep a lot of this conversation was driven by your comments. So keep leaving us comments, keep letting us know what you want to talk about, and keep watching and subscribing because we really, really enjoyed doing this for you guys. So with that, we'll see you next Monday.
Thanks, guys. See you, Dylan.
Get long, get paid.
Get long, get paid.
Paid.